Hello everyone, I'm Rakshith Pai and in this video I'll explain what portfolio allocation means and the two most important rules every investor must follow. These are for retail investors. In one of my earlier video I have spoken about how to manage your portfolio. To check that video out, click here. No, I guess it's here. Check out, the link will be here. Check it out. So let's get into topic. What is portfolio allocation? Portfolio allocation is nothing but an investment portfolio technique that aims to balance your portfolio, that is your investment risk, by dividing your investments into various companies among major sectors. Sectors such as banking, finance, FMCG, auto and others. Each sector has different level of return and risk, so they behave differently over time. I have always considered portfolio allocation to be one of the most important tasks an investor must do. It's like you're going for a war. You want best warriors on your team, but not one member of your team should be given supreme power. Because if he falls down, so goes your entire army and you will end up losing war. Same logic. Not one company in your portfolio should be given excess weightage than it requires. On an average, a retail investor can manage on his own a portfolio of 10 to 15 companies. By allocating your portfolio amongst these 10 to 15 companies, each company should get weightage of 1 to 10% at max. If you are a retail investor with a full-time job, please be sure to follow the following two rules. Rule number 1, minimal diversification. You shouldn't own more than 15 companies in your portfolio, no matter what. When we plan to invest in any company, we look into many aspects, and once we start owning them in our portfolio, our work gets increased by threefold. Here on, that is when we start owning the company in our portfolio, we not only track their financial figures but also check into their non-financials, daily activities and be constantly active in checking what's going on in the company. We need to check into company's performance every quarter. Now suppose you own 15 companies in your portfolio. That's 15 companies quarterly statement. So in any given year, you are supposed to go through 60 such quarterly statements. It's almost like reading one statement for every week. And there are other reports too. So it is extremely difficult to anyone who hold a steady job, that is 9 to 5 job, and manage his or her portfolio if the same exceeds over 15 companies. It is not worth the pressure. Instead, an individual investor can do a far better job at managing a 10 stock portfolio and a balanced ETF or mutual fund to fill the rest 5 slots. For ETF investing, you can check out the video. I guess it's here. Check out the link. I have tried to explain what ETF investing is and have also shared my ETF portfolio. Do check it out. Anyways, here comes rule number 2, that is proper allocation. Now that you have decided not to own more than 15 companies at once, if you consider my point number 1, the next important step is to allocate optimally. The weightage of each company you own should be around 1 to 10%, 10% at max. This way, not one company in your portfolio will get more than 10% of weightage. Make a mental note to yourself that here on, I shall see that all the stocks in my portfolio may or may not get equal proportionate weightage, but in no case they shall go over 10%. Remember, the above mentioned two rules are for those individuals who have a full-time job or are new to stock market. An individual who has good experience in stock market and has seen corrections to sustain them, they shall hold more companies and allocate as per their needs. If you are interested to know about my stock portfolio, which includes stock, ETF and bonds, check out the link in the description. I have attached a PDF of around 30 pages in which I have shared a detailed note of my portfolio, returns I have earned and 3-paragraph short explanation on each company that I have invested in. That's it for today. Thank you for watching.